Next question. Mr. A is contemplating the purchase of 1000 equity shares of a company. So information is given that say an investor is considering to buy 1000 equity shares. His expectation of the return is 10% before tax by way of dividend with an annual growth rate of 5%. So he is expecting return of 10% and growth rate is 5%. The company's last dividend was rupees 2. So D0 is given rupees 2 per share. Even as he is contemplating, Mr. A suddenly finds that due to a budget announcement, dividend have been exempted from tax in the hands of the recipient. So now the dividend income is not taxable in the hands of the investor because of the recent said announcement. But the imposition of the dividend distribution tax on the company is likely to lead to a fall of dividend of 20 paise per share. So instead of rupees 2, we understand that so the dividend per share would be 1.8. A's marginal tax rate is 30%. Calculate what should Mr. A's estimate of the price per share before and after budget announcement. That is the question. Please go through the question, all of you. So let us answer the question. Working note number 1. Calculation of D0, comma, after budget announcement. It is rupees 2 minus 0.20, that comes to rupees 1.8. Next, working note number 2, calculation of D1. D1 will be found as D0 into 1 plus C raised to 1. So we understand it said before and after budget. That is before budget it was 2 into 1.05 raised to 1, and after budget no information is given about the change in the growth rate, so it will remain same, 1.8 into 1.05 raised to 1. That is 2 rupee 10 paise. Next is 1.8 into 1.05. That is 1 rupee 89 paise. That is the way the D1 will be calculated in both the situations. Next, calculation of P0 before budget. Dear students, the question is clearly providing the information that the investors required rate of return before budget was 10%. So it is D1 divided by K minus E. What is D1? It is 2 rupee 10 paise divided by cost of equity, which is provided to us in the example as 0.10, less growth rate is 0.05. This is the way we make the calculation of answer. So 2 rupee 10 paise divided by 0.02, sorry 0.05, that comes to rupees 42. Please write down answer. Now, friends, when we are supposed to calculate the price after budget, then in that case we understand that whatever the income that we receive is post tax. So the discounting rate should also be post tax. We understand logically that say earlier the investor had a return expectation of 10 percentage, because whatever the investor was getting from that 30% was paid in form of tax, and the remaining 70% was retained by the, so that was the net earning which the investor had. Now after the budget, what happens that say whatever the income received by the investor will go directly in his pocket. He does not have to make the payment of income tax. So what will happen, importantly we understand like this: after budget announcement, after budget announcement, first of all we will make the computation of cost of equity. We understand it is pre-tax cost of equity into 1 minus tax rate. Earlier there was an expectation of 10 percentage. Now what will happen, 10% into 1 minus 0.3, the expectation will be 7 percentage after budget. Why? Because now you don't have to pay tax. And P0, as far as the calculation of the P0 is concerned, in that D1 divided by K minus C. D1 we already have found, it is 1 rupee 89 paise. Cost of equity is 7 percentage and growth rate is 5 percentage. So the numerator is 1.89 divided by 0.02. So it is 1 rupee 89 paise divided by 0.02. That is the way the P0 is found. That comes to 94.5. So write down this cost of equity and then price of the that is price of the security calculation. Please write down with paragraph. After budget announcement, comma, investor will get direct income, comma, without tax effect, full stop. So required rate of return will reduce, full stop.